Hello, everyone. Welcome to our 21st edition of Market Talk. So a lot of craziness out there in the market. We are in small committee today. The summer is approaching and most of us are now thinking about holidays. But we'll try to to keep the discussion interesting for you guys. And we have a lot to show you. So first on will be Ted. Ted, so what do you see in the market? How do you go through this craziness that we have encountered these past 2 weeks?
Yeah, thanks for having me on again. Yeah, I think you said it well. It's been a very challenging market, and I have been largely playing very small. But let me share my screen and kind of run through my process. Yeah, if you can enable that for me. Okay. All right. Okay, so as usual, I'll run through my investing and trading process, hitting on macro regime, taking a look at market signals that are either confirming or disconfirming the current regime that I think we're in. Take a look at some trades that I've been working through, and then just a quick snapshot of my trading account positioning. So from a macro regime perspective, this is a new release from the Conference Board on their leading economic indicators. Continues to deteriorate, so it was down -4.5% over the 6-month period between October 22nd and the reporting period of April. And so that continues to steepen, and you can see in prior sessions or in prior years when the LEI drops below -5, we've clearly entered a recession. So this has been projecting recession for a year now, and arguably we may not be in it yet, or we may be, hard to know, but clearly that indicator is suggesting as much. Just looking at retail sales, as you know, this is came in at 1.6% year over year in April. That is not; those are not inflation-adjusted numbers. So on a real basis, if you subtract 5%, 4.9% from the 1.6%, we're clearly running in the negative as far as retail sales. Retail sales make up a huge portion of the overall economic activity in the United States. So it's a major factor in terms of looking at how are we doing economically. Corporate profits have also started to decline. We can see we're in the second quarter now of declines in corporate profits, down 6.5%. And this isn't just EPS reported numbers, which are kind of manipulated by all the share buybacks that are taking place. This is absolute corporate profits by all companies in the United States. And so those have started to decline about 6% year over year. And what's holding things up, however, is continuing unemployment claims. Basically, while we had a bit of a burst in the early part of April, those have settled in. There's no real change. So people who are becoming unemployed are finding work rather readily. And so, that's holding things together from a consumer point of view. The Atlanta Fed, however, is forecasting growth of 2.9%. If you remember, this is for Q2. If you remember last quarter, they basically held on to a 2 handle right up until the day before the release, and then they dropped it to plus 0.6. So I don't have hold a lot of faith in this particular nowcast, but they are projecting plus 2.9% as of May 17th. From an inflationary point of view, headline inflation continues to decline. We have sort of plateaued here at 5%. So this is the April number, 4.9% year over year inflation on a headline basis, and 5.5% on core. And you can see we really haven't made much progress since December. It's pretty much floating around at about 5.5%. So that's a problem, and it's been manifesting in the bond market for sure. So just from a policy perspective, I just had a chance to look at the minutes that came out yesterday afternoon, and just focused on this piece regarding the balance sheet and money markets. Balance sheet runoff continues continue to proceed smoothly, and overnight secured and unsecured rates continue to trade well within the target range for the federal funds rate. So yeah, while the Fed balance sheet did, this is basically measuring your quantitative tightening and the constant liquidity drain, we did have some emergency funding that was issued to help bail the banks out in the March-April timeframe, but you can see that just continues to run off. This is as of May 17th. We'll get an updated number tomorrow, and you can pretty much imagine that that's coming back down. So QT is continuing to draw funds from the market, which means less liquidity generally. You can also see that in M2. So money supply M2 from a year ago basis continues to decline. So money's coming out of the market. Liquidity is not as available as it was even a year ago. So I'm calling this based on growth down, inflation down, deflation type environment, and it's kind of confirmed by market signals. What I mean by that. So US dollar tends to rally into a deflationary environment. We saw the day that Stan Druckenmiller came out and said he was short dollars, that this thing almost to the day started to turn and go higher. We talked about that last time a little bit, but we've had a pretty good run. This thing just keeps smacking up against the top of the range every day. Did so again today, and just keeps pressing higher. So an interesting phenomenon. Copper, the doctor is definitely sick. This thing has just rolled over badly. It's an economic, confirming economic weakness. I think that weakness is coming from China. You can see China has had two standard deviation moves over the past 2 months, and now it's starting to really break down. So that Chinese story that basically said, "Hey, China's back and basically providing economic activity for the rest of the world," doesn't appear to be true, or at least hanging in there. So something's up in China. It's definitely shifted to bearish. It was holding on to a bullish trend in my work, but it's shifted to bearish. USO, not particularly, oil has been shopping around. It hasn't really been able to make it too far back up into the middle of the range. We talked about this a while ago, where crude was holding a pretty steady range. It broke down, came back up. It's trying to find some legs here, but sold down as much as 3% today. I don't think it closed that low, but it was definitely down. So showing some signs of continued weakness. One of the things that's not like the others is the 10-year Treasury. You can see this thing has just not confirming a deflationary environment. So it speaks to more of a stagflationary environment where we have growth down, inflation sticky, and a 10-year bond that is just continues to tap the top of the range every day as well. My range today was around 380, and I think it closed about 380 today. So it's just been strong. I think there's two factors here. One is the debt ceiling, and the threat of a potential debt downgrade has certainly not been helpful. The second thing is that people are pricing the planned reissuance once a debt ceiling is resolved. Treasury will be back in refunding and pulling more funds from the market. So it may be that those securities are going to cost more in order for, or price higher in order for people to pay for it. So we'll see. And then we have the Qs powered by AI. So I think everybody's well familiar with the NVIDIA phenomenon here, and just 4 or 5 stocks holding up the market. I'd call it both artificial and not intelligent, but nevertheless, it is up and to the right. Compare that with the Russell, which is 2,000 companies. I'd say if Qs are powered by AI, these are powered by reality, and it's not a particularly bullish looking chart in my work. So as I look at the framework, as I see what's going on, I haven't changed a lot in terms of approach since 2 weeks ago. A significant allocation to bills, earning 5.5 now. I think the 6 months now at 5.5, 5.4. Core positions, both long and shorts, trying to trade around. Basically, as traders, we've been given sort of wide 1 to 2 standard deviation ranges that we can kind of position to move in, and I tried my best to work in those. It's tough buying at the long end of the range, low end of the range, because you don't know if it's going to drop further. So you have to trade with good stops, which I've been doing. And then if I get some profits, particularly short side, I'm taking them usually pretty quickly because they don't seem to last long in this market. From a trading perspective, this was a position I shared last time. It was DBA, which is our agriculture. In the commodity space, it was trading pretty well, hanging on to bullish trend. As I told you, had been buying here. I sold some here. It came down to the middle of my range. I bought a little bit more, and it didn't follow through. We had a failure here at 21.16, and so I sold the balance of my position yesterday, and the thing continued to break down. So at least, I made a little bit of money and I got out whole. I'm not sitting there saying, let's buy the bottom end of this range at this point. I mean, we could get a bounce, but it's dangerous. I've also continuing to build this eyeball position, which is focused on the steepener. I've been buying at the low end of the range here. I bought the other day, I bought today, trying to basically build a position. It's basically been in a consolidated range. I am hoping to play top and bottom. I caught this position, caught this trade well, sold some here, bought more here. So at the middle of the range, then I bought some more at the low end of the range in the last couple of days. This thing is turning down though, so it's a very tight leash for me. I won't sit on a loss. RWM, which is short Russell. So I'm long RWM, which is short Russell. This continues to be a decent trade for me, or a decent position for me, and I trade around it. So I bought some here about a week or so ago. I'm still holding that. Probably should have sold some today, but I'm holding out for a higher price. So I'd like to see if we get some follow through over the next couple of days. It really turned around once OPEX expired, and we had the little push on Monday, and then it's been down for or in this instance up for the last 3 days. GDX is one that I tried to ride. I bought some here in the middle of the month. I sold a little here the next day, trying to buy more, bought more here. And then now this thing is just failing and I'm not hanging on. So I've been cutting position. I still have some position in it because I'm thinking this thing is really oversold, but I'm not hanging on to the bulk of the position. SJB, which is inverse HYG or high yield. It's a position that I hold. I haven't traded too much around it. I bought some on the 1st of May. I sold some a little yesterday. I'm still sitting on that position, and I think when the proverbial poop hits the fan, this thing is gonna continue to pay. I told you last time when we met, I was looking at SPHB, which is high beta. We got to the top of the range last week. I sold some here short. I sold some here short. I didn't like the price action the day after I put it on these two shorts, so I took half of my position off the next day, and then I closed it when I got some price reprieve here. So let's just say that with shorts, I don't hold them long. And this thing, here it is today. It's up again. It just, everything's kind of doesn't want to stay down. So I've been hesitant to hold shorts long. Oh, okay. So then trading account, I'm sitting on 84% bills. I have a VIXM position. Interesting with VIXM yesterday, we had a nice pop in the VIX. We had a nice pop in VIXY, which is near term, but nothing in terms of medium-term VIX futures. So it's not terrible. It's not working that well. And it just tells me that all of there's event risk in the front of the contract with the debt ceiling pending, or decisions pending on that. Eyeball, we talked about 2.5% position. CTA is a good position. I just keep holding it. I don't trade it much. EWW, which is Mexico. I continue to trade this. I actually bought it added to the position a couple days ago. It was up yesterday into a down tape and a strong dollar. So the Mexican peso has continued to do well. It's still a bullish trend. I'm hanging on to it. We talked about RWM, 1.8%, SJB, small position, GDX down to 1%. I'm also building very slowly because I don't like natural gas, but it's trying to put in a bottom, and I'm basically just adding a little bit to have some commodity exposure to what may be an inflationary environment continuing to go forward. So that's what I got for you guys.
Thank you, Ted. A lot of very interesting data points regarding the current battle between deflation and inflation. And surely it's been a very tough ride, especially for people who try, for example, to buy bonds, as it used to be the right play for the deflation scenario. But something is not giving. And maybe, Chris, you have some idea about how the battle goes between deflation and inflation, and what do you see currently in the macro, and also regarding your signals that you have developed? What do you see there? What do you expect for the coming weeks regarding the different asset classes, different countries that you want to talk about?
So, all right, I will share my screen real quick. All right, so I wanted to share my estimation for the global macro regimes. So basically, it's still is a tough battle between stagflation and disinflation. So what you can basically see here, or what I would like to look at first off, is the mean outcome, which is right at the bottom. And you can see that disinflation is globally, as a mean average, the most dominant regime with 34.6%, and disinflation is right behind with around about 25%. So yeah, of course, if you look at the trending change in CPI, of course, it's per definition a disinflation. But as you already said, bonds, it still is even if it's a small bullish trend, it's a very weak trend, or it continues to degrade over a longer term perspective. And that's pretty tough to trade, because we got the signal in the slowdown in global growth, and it's also in some way proven by markets. So what I try to do in this kind of analysis is to aggregate some stock returns for different sectors, look at the change in yields and the change in high frequency data. I comprise this data, reduce dimensionality, and overlay with a machine learning model. And I use either leading indicators from the OECD, and if they're available for the country, or GDP, always on a trending basis. And inflation is pretty standardized around the globe. So what's kind of interesting is that Germany, even if the recession is announced technically, it still shows that leading indicators are ticking up. You see this in the IFO indexes. They recovered pretty hard. If you look at expectations or coincident indicators, which is kind of surprising. Living in Germany, I really don't see any real manufacturing going on. Prices are really high. No one wants to invest. Labor is still pretty strong. We got subsidized for energy costs to a fair point, which in my opinion is most likely due to the enhanced government spending, the thing that keeps the German economy going to a certain bit. What's interesting is China, as already mentioned, does not show any signs of growth. I recently stated this in a Substack article that I always look at energy or electricity consumption as a basis for any reflationary impulse. And one data point is coking plant utilization, which usually leads electricity generation or consumption in China. And this thing also did correlate to some extent with economic surprise indexes, and these things they diverged. So basically, coking plant utilization is really below reflationary standards, and so in my opinion, there's also no real growth impulse in China. So this thing collapsed, and China is, based on my estimates, back in stagflation. This inflation is also at a very high growth probability, but growth is really, really low. And this can be seen throughout the globe with some countries showing recently some strength. But if you look at the macro signal strength, it's the right side. This is basically the same input for the global macro regimes, but I do not try to explain GDP growth or basically growth probability and inflation probability, but look at stock price momentum. So this is a higher, or basically if it makes the stock index if it makes higher highs, then the probability should be high. But at the current data estimates, these things are trying to break down. So the recent rally to this extent is really not explained by general macroeconomic data in this current environment. And also, if you look at mean data, we're at 32.6% on a weekly average, and on a monthly, we're at 36%. So this is basically a bearish sentiment throughout the globe. If my models turn out to be correct, then this is really not explained by any data currently in markets. So this is for the global regimes, and for a country which bothers me quite a lot is Sweden, because this thing breaks down and has basically, in my most likely, the worst economic data available. And recession probability is ticking higher. We are seeing that it's right around 90%, and it keeps on climbing. So interest rates are signaling this. Based on regime probabilities, we're seeing that inflation is still a very high problem for Sweden. We're at 10.4% for the CPI in year-over-year terms. Disinflation is ticking higher a little bit, but my models still see a lot of inflationary problems. So this is really not a good setup for this country, but yeah, stock price action would suggest otherwise. And also the real estate sector is really breaking down. The real estate sector is signaling like a very high probability. It's like 60% probability of a recession, solely based on real estate, retail sector sales. And it would suggest possibly a GDP of -5% year-over-year. And this signal lasts for like 4 to 6 months now. Also PMIs, Swedish PMIs are also signaling now 60% recession probability. So this is manufacturing and services. They also signal a somewhat low GDP number, but this is also not reflected currently in the stock price. Another thing that I find very interesting is if you look at some top level financing or money creation, you look at banking and credit, basically loan growth on a year-over-year basis. And also you look at government spending, and the blue chart shows the percentage of central government spending. So this is basically a 12-month sum of the recent surplus and deficit. And it shows that we're seeing that they are running a very high surplus. And this is usually not a way to finance an economy which is breaking down. And also, you should Sweden should be thinking about this, because their private debt level is at 260% to GDP. So during GFC, the private debt in the USA did not exceed 160 or 170%, if I remember this correctly. So this is very outrageous, this kind of level, and it's not it's solely financed by the private sector. Government debt is very low. It's like 30-ish% in Sweden. So basically, the private sector is taking all of the increased cost burdens if interest rates rise, which will drastically increase their debt service, and this is not good if retail sales are already down this much. Also, you can see that year-over-year growth in loans is also coming down. So if this thing turns negative, you can see a spiral out on GDP. So this directly influences. So these things I'm currently watching for Sweden. So I hope that price action will confirm this kind of bad data for the economy. But if I look at my forward return analysis, or give a short overview, so you can see there are three types of data. So you can see rolling Lyapunov exponent. This measures the exponential divergence, rolling Hurst exponents, and a rolling entropy measure. And below you can see a midpoint value, which is my momentum indicator. This is optimized by looking at returns. So it optimizes returns by minimizing crossing. So each time the stock price crosses the midpoint value, this gets marked and counted. And I try to minimize that while maximizing returns. So currently it's at 135 days. So you can see this here. And it's close to a trend regime change if you look at the midpoint line. But it did hold, last time it held its trend for the EVD ticker. And also the quantile prints, which is the 50-day forward prediction using the three exponents above. We're currently, we had some blueprints, which is a quantile 2. So over the next 15 days is the mean outcome, minus 1.2%. But now we're getting a quantile 3 print, which is basically mean reversion. So it's 0.9%. And I'm not getting any signals for Sweden to break down or break down hard. So maybe this thing will again hold trend. But the next days there are kind of interesting. We'll see. Also, if you look closely at the Shannon entropy, which basically is a measure of unpredictability in a system or in a information system, the higher this indicator goes, the less predictable anything becomes. So you will see this in recessions. This thing spikes pretty high, always kind of like a volatility indicator. We are currently at a somewhat high level, but I would like to see this thing go even higher. Basically, the 50 and 100-day rolling windows, they should move higher each time. The 3-month difference did this. It was a negative input for future stock prices if you want to short it. But for now, all of these indicators, they're falling. So this thing becomes more stable and more predictable, which is not a good thing if you're on the short side. And as well, these Lyapunov exponents, you just need to remember two things. If it's negative, it's a stable system. If it's positive, it becomes less stable. So currently, these are all negative, and it looks like that the system, or basically our stock price movement, becomes more stable. And each time this thing spikes or stays at a positive level, the non-linear moves are more, they come up more frequently. You can see this in 2020 during the Corona shock. You can see this in 2008. You can see that these things are going high. This indicator goes high. It falls in a somewhat predictive in some time frame, but then moves not below 0 and then goes higher in a recessionary environment. And this is clearly not the case now. It's kind of frustrating because of the economic data. But yeah, so I also show some for some other ETFs. So you can see SPY. I updated the model today. So it takes the last 8,000 days. So let me zoom in. You can see got some quantile 2 prints for the SPY ETF. So it's minus 0.3% over the next 15 days. These ranges are basically the 15-day moving averages of the predicted values. So they diverge a bit. But at this point, downside is somewhat kept, and the optimized midpoint is at 63 days. So basically 3 months is the best way in my system to trade it as a momentum indicator. And you can also see entropy. It's not rising, it's falling, signaling more predictability. Hertz exponents are somewhat in a mean reversion state. The 250 days, it's very low, so we can see some frequent changes. Lyapunov exponents also stable, so they're also falling. Nothing good for the short side at this current time. But the tendency is somewhat mean reversion, somewhat going lower, maybe sideways. But there's still a good gap to the midpoint value, which is at 402.29 on the latest estimate. Another one is the Qs, triple Qs, so Nasdaq ETF, and also it's a stable Lyapunov exponent, and we are seeing that Hertz exponents are also on the 100-day, they're pretty high. On the 200-day, they're in mean reversion. 250-day, it's below that. Entropy also, it's also falling, so same as in the SPY. And based on the forward prediction, you can see that this thing has some upside left based on my model, and the R2 on the test set is 0.7. So this model explains 70% of the given variance. And yeah, the latest quantile print was a Q3. So basically 1.3% over the next 15 days is the mean outcome. And this thing, yeah, it does not stop. So a really mixed data. So price says one thing, global macro regime says shorted, but it's very tricky. It's a very tricky environment. So yeah, this was my presentation for today.
Yeah, very tricky. I think Bryan will concur. So if you are interested to get some more information about macro, I would encourage you to follow Christopher's Substack. I put the link to his Twitter profile in the description, and there is a link to his Substack from there. So he covers most of the countries he has shown in the first board. And yeah, it's always useful to know what others are viewing in the market using other data points.
So does that mean long queues long SPY and long EWD. That's what I got from that. Is that right, Christopher?
It's basic. Yeah, I would love to present otherwise, but given that's what the numbers say currently.
Absolutely.
It's crazy.
It's crazy.
Yeah, really. So I haven't even looked at Nvidia, so I'm not strong enough for this.
Maybe we get some more how to say bearish data from Bryan. So Bryan, can you please help some hurt bears out there?
Yeah, I can help some hurt bears. I think general point, there's so much to go through. I was trying to think while Chris and Ted were talking, like what I'm really going to talk about. I've been writing so much every day about this, and there's just so much stuff. Broadly, I'm really tired, man. I mean, I'm not one of the most demoralized bears out there, not even close. I mean, there's been people that have been shorting this market since March and have gotten like the main squeeze. I've just been trying to short really aggressively since May, and it's just 25 days in, and I'm pretty beat up here. Portfolio's doing fine. There's been a lot of good stuff that has worked, and so there's great shorts to go to that aren't tech. But I'm not saying capitulate on your tech right now. But I think people are so demoralized and wrecked since March that maybe they made some crazy decisions and capitulated on NASDAQ shorts this morning. Nonetheless, I'm not doing that. I'm actually rotating more into those shorts and covering things like Russell and defensives that I've been short. So let's just go through it. I'm just going to kind of run through it and we'll see where we end up. Like I said, there's so much to go through. I've been writing so much every day that it's just like it's hard to think about what happened. So like I said, I've really only been aggressively shorting since May. I started getting there in the start of April. This was the last bounce that I thought was going to be the end of the BMR. It wasn't. But we've broadly just kind of gone sideways since then. The main thing, like if you didn't lose money from here to here, you should be just feeling really great right now, in my opinion. That's kind of where I'm at. I made a pile through this from February 2223 bear capitulation day, got very short, especially overweight Russell through that move, covered a lot here and didn't lose any of my gains through this squeeze. So where I'm kind of at as bear right now is I can be patient. I can wear a day like today after making a lot the last 2 days, or even this, I can wear that. I wasn't quite happy about wearing that, but I did in some way. But I can be patient in this market because I know where it's going. And Raphael's going to talk about his daily VIX signal, which is a big thing for me right now because some other signals aren't quite there. But that one's a big one. So we know this is going to a VIX spike. Whether that leads to something beyond just a dip to 400 or 4,000 the S&P, I don't know yet. I hope it does. I think that the March drawdown could have gone to a more significant dip, but it didn't, and it was saved by the Fed and the bank blowups. So that wasn't the thing that caused the rally. As I've said many times, that was the thing that ended the sell. So that was really annoying when that happened, but hopefully we don't get that this time. And I like what I see out of bonds and gold absolutely selling really aggressively. It tells me that might not be what happens. And we haven't really gotten any signals that bonds are going to aggressively bounce here yet. So let me start with this. This is like my macro dashboard. It's very simple. It's just looking at performance. And I was just starstruck looking at this one. Everyone knows this. Everyone, you go on Twitter, like all you hear about these days is how bad breadth is. But I mean, especially after this 2 and in a lot of ways 3-day sell that we've gone through here. I mean, the Russell closed pretty significantly red today. It was a pretty bad day for the Russell. And like the only thing that was green today was Nvidia and tech, and industrials like snuck in there at the end. And so like breadth has been really bad. And the worst thing is that everyone's longs have actually gotten wrecked the hardest. So people long in utilities, long in consumer staples, getting extra long consumer staples here are getting absolutely wrecked. The worst performing asset over the last month, energy, utilities, and staples. And so I was shorting a lot of those. What we got a few weeks ago, a lot of the long-term ranges in MFR got capped, especially on consumer staples, on names like Hershey's, KMB, I think PG was there too. A lot of these names that have gotten destroyed were leading lower. So defensives broadly have gotten hit. And I think that's also looped into the sell that you've had in bonds. Everyone was positioned for the imminent recession. We were pricing massive cuts through the course of the beginning of May. We were pricing imminent rate cuts. Now that didn't translate itself immediately into a broad equity sell. As you see, the S&P against all these sectors that are red, S&P and NASDAQ are green over the past month. Russell's even green over the past month. And so I think people have had to capitulate on their bonds. And so that's what's been happening. But this capitulation came from a relatively high level. So like, I don't think we're anywhere near the bond sell. I will say that TLT, for example, which is the one that I'm short, has broken firmly to bearish trend. It is a little skewed to the upside in terms of the long-term range, but it's just going. And Hearst broadly within fixed income space are decent. TLT is not that great, but I'll show you the others here in a moment. So there's room for it to continue going lower. The MFR ranges are continuing to move in that direction. It's not capped to the downside yet. And, you know, I wouldn't start a new bond short here, but I haven't covered mine. I have both puts and short TLT that are working great against tech stocks, which have squeezed me. So you have that one. Like we look here at snapshot. So yes, like TLT's bearish trend, but IEF, European bonds, which I'm short, and SHY, they haven't actually broken down yet. So we're in this position now where, you know, people that were on it and shorted bonds a couple of weeks ago, shorted them when they were pushing neutral to bullish trend. And like I mentioned in the interview with Raphael, the best shorts are the shorts that are bullish trend because you have so much runway. You short them at bullish trend, then they break to neutral, then they break to bearish. Like you had a TLT, we shorted that one when it was broadly neutral, and now we get so much runway out of it because you can stay with it as it transitions lower. And gold's another one. Gold finally broke down today to neutral in MFR, but it's been bullish trend throughout this entire sell. So if we keep going here, I mean, now it's really going to pick up. If you look at, you know, Raphael, I'm sure you're going to talk about gold. Last podcast before the sell really started, I mentioned I didn't really have anything sticking with gold. It was more of a macro perspective, and it's the same perspective as why people have dumped their bonds, why people have dumped all their defensive stocks that they were long, and why people are are aggressively selling their gold now is because recession's not here. We're not seeing anything in labor that's confirming recession. Inflation is still sticky. We need to price out the cuts, and we need to sell down all this stuff that people bid on those expectations: bonds, gold, defensive stocks. And so, so gold, I mean, it could absolutely fall off a cliff here. I'm sure you're going to talk about that, Raphael. But the same idea with gold, as I mentioned with TLT, the skew is not that great from a long-term perspective, and but we're not capped yet, and it's also still bullish trend. So I'm not too worried. I care most about when something's moved to like bearish trend, and then you have the excess long-term downside at zero. So that's capped to the downside. Those are the ones I care most about. Now we're just breaking from a trend perspective. That'll start to open up yet. And I already saw the near-term range on gold open up as well. And that has a really strong Hearst of 0.71 against the dollar that is continuing to the upside as well. And so UUP here has got a Hearst of 0.71 as well, but same idea. It's not skewed that great, but it's not capped. So what does that mean? I don't know yet. All I know is it's going. It's really going, but it's not causing the mayhem in the broad market yet, but it is certainly influencing this destruction of defensive equities and whatnot that you've seen under the hood. It just hasn't transferred yet to the stocks that we really want to short. And so where I'm at, where I've been this week is I was short a lot of these stuff. If you look here at my current position, so these are all the public positions I sent out on Twitter. All of these are still open. I've just input the current price to kind of show you guys where I'm at in terms of P&L on them. So the book is in the green. Just what's not in the green are my SPY puts, which are in the graveyard, QQQ puts, which are in the graveyard, my recent tech short, and then this little other tech name that squeezed a little bit today. So broadly, it's working out well. It's just I am long a lot of puts, and I've added more since I sent these alerts out there, because as you got all those bumps in SPY in May that went up here to, 420, I think was the high, around about 421. They all were on a crush of 0% IV ranks. Vol got the cheapest it's been throughout the entire bear market. I think I sent a tweet out here. I want to say it was on this day, either Thursday or Friday. Both QQQ and SPY IV ranks were both at 0%. We've never seen that before. When we were starting to size into the SPY puts here and here, it went to 0%, but QQQ wasn't there. QQQ joined it, and it was a full capitulation of puts on this day here. Since then, we took the down move, which worked great for the puts. These and others bid very nicely. And then we had the bounce today. What's really interesting on the bounce today is that it actually wasn't a put squeeze. It was a full-fledged chase of real money buying and calls. As you see here, IV ranks barely moved down. Like yesterday, they were at 19% on SPY and 12% on Qs. The day prior, they were right about where they were now. Actually, Qs was at 6% the day prior. So some puts obviously closed, but it wasn't predominantly put selling today that caused the squeeze. And you saw that obviously in broad markets not squeezing. And so where that puts me at now, with the Russell having sold, a lot of sectors having sold and not really giving me shortable signals, is that I've transferred the shorts I had elsewhere and I'm rolling them more into Apple, Microsoft. I shorted Nvidia today. We'll see how that goes. I'm rolling them into that because that's still where the downside is. And I don't think the puts that have bid this from a 0% IV rank to a 9% now over the past 2 days are just going to capitulate. They didn't capitulate today, so clearly they weren't buying puts because of Nvidia earnings. That didn't scare them very much. They're buying it for other reasons. So if there is a squeeze that takes hold, I think it's going to be via broad market breadth coming back. So the rest of these sectors bouncing, staples, defensives, they could all bounce. And that would lift and catch up to where the NASDAQ is. And you see that with IVs. So 35% IV rank on IWM. And just so everyone knows, like IV rank, it's a very simple, it's my favorite way to measure implied volatility. I stopped looking at implied volatility premiums and discounts because they're very skewed by where our vol is at. And in the current regime, we are like with realized vol so suppressed, it doesn't give you actually a good measure at all of how expensive or cheap puts are. So I just look at a 1 year IV rank. 0% is the cheapest IVs, is at the money implied vol. Cheapest implied vol for the past year is 0%. Most expensive is 100%. It's a linear relationship in between. It's a very simple way to measure it. And it gives you a lot of information to kind of where you're at. And so IWM is bid, XLY. So like you see sectors, they're all bid here. The tech ones are obviously lower. Tech was at 0% IV rank, not too far. So that even bid up today. So you actually had vol up, stocks up in XLK, SMH, and Nvidia, which shows that it was all call buying. There's no puts in these names at all. So there's no downside protection, which could cause a complete rug pull. There's no support as you go lower. And so, so like you got a very unstable move there, and vol is still well bid. And so I like that. If there is a squeeze, it's going to be the puts that are in names like XLRE, XLU, XLC, not XLC. That was also bid up as well. XLB, XLI, IWM. And so I like covering the names today that are Russell components or broad, cyclical stocks and rolling them into tech. And so that's what I did. I try to leave things on the Twitter alerts so I don't scout people. So these are all still open. I still have broad positions in all of them. They're working great. And so I think the two options we have are broad market squeezes and catches up to NASDAQ, or these continue pushing lower. And there is room, I'm getting some oversold signals, but nothing is capped to the downside, really. I mean, there's some names like if we look here on downside caps of the 0%, they're small. PayPal is one, Airbnb is one. There's very few. There's a lot more names that are coming from 0% excess long-term to upside, like Hershey, for example, that were better shorts. And so I won't short any names that show a downside cap, but broadly, like where the market's not oversold, looking away from SPYs and Qs, and the rest of the broad market is not oversold yet. And so I think those could continue bleeding lower if we get the mega cap tech sell. Now, what the question is, do we get the mega cap tech sell? So right now, the big levels on SPY and QQQ, yesterday they chased puts into 410. 410 became the put wall and absolute gamma strike. Now, I look at that more since we're not like near a formidable bottom where it actually look for a BMR to start, because broadly in May, we've gone nowhere. We're towards the top of wherever this BMR turns. It was a put wall. It was downside support, but I didn't look at it as something that was a screaming signal for me to cover. I knew that this squeeze was possible. Raphael will talk about how he called the squeeze very well. I knew it was possible, but I also knew that with all those puts that were at 410 yesterday, if we did go, which I would argue that if NVIDIA didn't pump today, we would go. Now, that's a tough situation to get yourself into. The trader shoulda, woulda, coulda, but you look at the way Broad Breath sold down so hard today against the tech pump, knowing that 410 was right there. If we had broken 410 yesterday or today, it would have been a huge sell, absolutely huge. So I was willing to stay allocated on the short side for that potential. Didn't happen. So now we squeeze back up to 415, 414. Now, they chased calls very hard today. 414 is the current call wall. 415 is absolute gamma. They completely chased it. What this means is that if we reject at 414 and 415 tomorrow, that's going to elicit call selling, which now that VIX is actually relatively elevated, people are willing to do that. And they'll dump their calls, send us back down to 410, which is gamma flip. If we break 410, VIX will go for its next leg higher and bid. That's kind of the playbook on SPYs. On QQQ, now this might be skewed because of the close, because they probably, yeah. I mean, so nonetheless, the same thing they did with 414 and 415 on SPYs, they did it with 340 on Qs today. So if you look at like the behavior that we got intraday at 340, it was a very, very firm wall. We took some attempts higher, but broadly we closed below it. And so that's a good sign. If whatever news tape bomb comes overnight and we dump and gap down below 340 tomorrow, that will elicit big call selling on Qs and a lot of selling from dealers. And the big thing on Qs is the same thing that I was talking about with XLK, NVIDIA, SMH. There's no puts. There's absolutely nothing. I mean, look at that. There's nothing. It's all calls. They've completely chased this. And so like a big gap down, there's no support for anything to run, to bounce. It's just open air. So like at least SPYs have like 410, SPS not gonna work. Let's adjust that here. At least SPYs have 410, which is something we still need to get through to help, but Qs have absolutely nothing. IWM, now the thing that's the trigger for me of whether we would actually have a broad market squeeze is IWM 175. So IWM 175 is gamma flip as well as absolute gamma. So holding below that keeps a bid on Russell volatility, and it promotes instability and more breakdowns. And so the fact that we failed at 175 today was what led to a lot of the selling that you saw in Russell and related components. And that makes it okay for me to stick with those shorts for now. So like the tech better because of other signals, but nonetheless, IWM below 175 is bearish. If it recaptures 175 alongside SPYs and Qs not selling, you could get a pretty significant crush in IWM vol, which would lead to a squeeze of crap stocks, retail, crap retail, all of that would squeeze higher. And so 175 is really key for Russell. We closed well below it today, I want to say. You know, I would love to close down here, but you saw intraday. I mean, like the Russell was crashing intraday. You know, I mean, this is not like a bullish market that someone should be capitulating in if the Russell 2000 is crashing intraday. Now, a mistake also with that when you look at that, be like, oh, okay, well, let me cover my tech and rotate more into Russell or cyclical shorts. And then now it's bad too, because a lot of that stuff is pushing potentially oversold. And then if it does squeeze, those are the things that are going to squeeze you the hardest. So yeah, but like the Russell is not, like Ted said, this Russell is not signaling risk on at all. One thing that I've been watching very closely is the high beta, low beta ratio. Now this one gapped up today. The reason it gapped up today is because NVIDIA is a big component as well as a lot of tech stocks. So I don't put much weight in the big bump up in SPHB over SPLV today. I said that in the morning that it's skewed. So that one bumped up today. What we did see the last 2 days very nicely, which I liked and what stuck me around, was two good down days for that ratio. Also in MFR, I have a real time. So this did go back to bullish trend on the bounce, but the long-term range now to the upside on this one is the same thing to the downside on bonds and the upside in gold and the downside in bonds, the downside in gold, and the upside in the dollar. Those don't have much runway to the upside from a long-term range perspective, and neither does Russell. In fact, oh, this is interesting. Oh, wow, this is actually really interesting. I just realized this. It's capped to the upside. That just got me a lot more bearish. So this transition to bullish trend today, and now we have a cap to the upside on SPHB over SPLV. Okay, that's a point for the bear camp that we just found out live. So that's a great sign. There's no runway for SPHB over SPLV to go higher. There's
Bryan,
just not.
Bryan, for this spread, another good point for the bears. Go back to trading view.
Yeah.
You can see the volatility vol indicator, the blue line. So you are basically near the lows. So that means no more runway, no more way down for volatility. So no more way up for price. So this is actually a good point.
Yes.
You have maybe several, maybe 2-3 days more, and then you're gonna get either sideways action or you're gonna get the flush that you want.
Great. Yeah. So there's the cap. So yeah, so that one's capped to the upside. So that's a great sign. XLU IWM, look at the other one. So, and the reason that I look at that one as well, is not just because I like high beta leading higher leads the broad equities higher. In fact, like the number one thing I was worried about when we got here was about on the Monday and the Tuesday before the squeeze really took hold. This is the bounce before today's bounce, the most, like 3 different bounces this month. The most recent bounce before this current bounce today. High beta, low beta started leading to the upside, which wasn't a good sign. And this is the same thing that we saw in December to January, which I was very worried about, whether it be something more significant. And so you saw high beta lead to the upside against an index that's flat and basing at like a key put level where you could get some kind of put squeeze, and that took hold. And so that was the base point of the significant squeeze. I wrote a lot of that on Patreon. I tweeted it out as well, gave all y'all that information. But so that happened. XLU, and the reason that's bad, if you look here, the correlation between SPHB over SPLV and SPY, it's very strong. 0.68 on 30-day and a 0.82 on the 5-day. So high beta going higher and outperforming low beta is a bullish signal. On the flip side, XLU IWM, defensives underperforming cyclicals, is also a bullish signal, as that has an inverse correlation to SPY. Now that did soften today, which is a good sign, I guess. Broadly a sign is that it's mattering a little bit less. You look at XLU IWM, and so that one bounced the last 2 days with SPHB over SPLV. If you actually look at the correlation between the two of them, it's very strongly inverted. So they have a direct relationship to each other, which is why I look at them very closely. So this one, I would actually long XLU IWM here. It could be a brutal decision. I'd rather put it all in the NASDAQ shorts, but that is an option right here. That one bounced greatly the last 2 days, and then now we sold today, partially because of just the defensive puke that we saw. So we'll see what happens with that one. But I'd like XLU IWM to continue higher and bounce here, as we saw the last 2 days. And I would like SPHB or SPLV to sell. But now that the cap is on this, it's set in stone. So like, I'm extremely bearish now that I see that. So there's that. Now, let's see. So we're talking about that. Broadly correlations. So they're just not, they don't freaking matter right now, quite frankly. I've kind of come to that midway through the last couple of weeks in the market. Correlations just they're not telling me much at all. Stock bond correlations firmly negative. Sector correlations softened today because you had the tech bump against a defensive sell. SPY UUP, it's non-existent, 0.01 to 0.06. And this is against the idea, like we've seen, dollar absolutely ripping, bonds absolutely puking. It doesn't matter if stocks are up or stocks are down, bonds not catching a risk off bid or a risk on bid. They're just a complete disaster. If you're really sorry for you, if you're long bonds, we talk about that a lot in here about why you don't want to be long bonds. DM me if you want more explanations on why to not be long bonds from a macro perspective, not just a signal perspective. They're not calling anything. They didn't call this bounce on high beta, low beta. So if we look at SPY, for example, they didn't call this 2-day rip last week. That's what high beta, low beta led that. Correlations didn't call it all. Correlations were actually strengthening through this chop. So they made me think that we could actually break, and is what kept me, actually one thing that kept me away from covering, which was kind of annoying. And they didn't really lead this sell down either, because they didn't really strengthen up here. So they're not mattering right now. They're not the dominant signal. The dominant signal for me is the high beta, low beta ratio. Dominant signal for me is Raphael's VIX signal. And then dominant signal for me right now is trend skews. So even with the bounce, we haven't seen SPY turn to an upside trend skew. It's still neutral. I would like it to be downside, but it's not there. It's just right in the middle. So there is excess long-term downside. So we're not oversold. We're not overbought. It's about right in the middle. It could go either way. Broad breadth says it should go lower. And then my target net exposure model. So this reads all tickers in my database. It doesn't just look at tech. It doesn't just look at SPYs. It doesn't look at Qs. It looks at all the tickers. And because of all that really heavy selling that we've seen in a lot of some of the single stocks that we track and short and whatnot, if you look at here, like a lot of stocks are working great on the short side. It's bad. It went a little more neutral today because we had that selling intraday, but broadly it's been firmly negative through this. So there is still downside. It's a little less today than it was the last 2 days, obviously, because things went down. But there's still a downside in the broad market. So you just have this crazy thing going on of people chasing these calls and loaded in completely on one side into bloody tech. It's just, I think, I mean, it's going to cause a freaking crash is what it's going to cause. So it's like where I'm at, I want to be allocated for that. Hearsts are light. So it's not like this is going to magically trend and continue day over day for sure. Raphael's VIX signal is there, which I can very trust, especially on the daily. These only trigger 3 to 4 times. It's only triggered 3 to 4 times in the BMR, and it's nailed it every single time. So that's going to work for us. Correlations don't freaking matter right now. The bond market is blowing up. Gold is blowing up. Dollar's ripping to, I mean, what it's the higher. Dollar has now recaptured all of its losses. Not all. It's getting there. Some names look like a 30-year yield, which is obviously more plugged into what TLT does. This thing, it's leading to the upside. So people that are, short, short the short end of the curve because they think the Fed's gonna be tighter, but they want to be long the longer end because recession is coming, have gotten absolutely whacked in this. That one is completely ripping higher. It's completely recaptured all of its losses from March 8th, which was the day that we were pricing the potential for a 50 basis point hike at that meeting. And then subsequently the SVB blow up occurred, yields puked. It's recaptured all those losses. Another key one from that end is dollar yen. Dollar yen's absolutely on a moon. That one's well above where it was March 8th. That one's leading to the upside completely. Euro's breaking down, but Dixie's looking great. So why is Dixie ripping? Why is the bond market blowing up? Why is gold blowing up? Partially because people are selling the defensive stocks and recession is not coming, but also because the Fed is staying hawkish. The same catalyst that's been the catalyst for all these sells, which is Fed hawkishness, is still the catalyst now because we're not at the point of recession. So what are we looking at here? We progressively now rebid the potential for another 25 basis point hike at this meeting. This was at, where's my thing here? It was at 20% chance of another 25 basis point hike on Monday morning. It was at 20%. So we've rebid that almost now to a 50-50 shot of whether they hike another 25 in July. Looking at July now, I look kind of really on the last 2 months. We're testing the potential of another 25 basis point hike for there, but then it's a coin flip that we're at least do another 25 basis point hike at June or July. I mean, I don't see why we shouldn't go back to the potential of pricing an upshift. What we saw in March was they priced the upshift from 25 basis point hikes to 50 basis point hikes. That was the trigger for SVP to blow up. And obviously that's not the exact thing that caused it, but it was too perfect. We finally got the upshift. They were going to hike 50 and then SVB blew up. So I think we need to move in that direction here again, at least move in the direction that they continue hiking. So, yeah, so that's where we're at. So that's why the bond market's blowing up. That's why the dollar's blowing up. And that's why tech will blow up. And Raphael will talk about it, but you got a lot of daily sell signals on some of these big names. They're not there in MFR. They're not there in my signals, but his things have nailed that. Google is there. Apple came from the lowest volatility it's ever been. Heavily short that. XLK had the mega sells when I shorted it there. That one bumped up today on NVIDIA. And NVIDIA, I shorted it. A quick learning that I've had, if you want to short things that do what NVIDIA did today and just blow through the top of the long-term range, the near-term range, and just, squeeze everyone. You want to short something after this, you need some kind of momentum indicator. So I've got Raphael's matrix here. Some kind of momentum indicator to tell you that hourly momentum is rolling. If hourly momentum is rolling, and then you have other signals that tell you to short something like NVIDIA, it's really good. So I did this with like Urban Outfitters. They ripped on their earnings report. Hourly momentum started rolling. That one sold. I did this with Tapestry. They ripped on their earnings report. Hourly momentum started rolling. Then it sold. So just a little trick that I've learned recently. If you want to short things post earnings, broadly on earnings, I actually haven't been playing them much at all. I played Goose. That's the only name that I've played in earnings. Oh, and Shake Shack. I got squeezed on that one. That was when I'm like, I'm not going to do that this quarter because broadly they've been beating and they've all been squeezing. It's just not worth it on the earnings report unless you have an edge, unless you have like a cap on the upside, which we had on Goose. It was 0% excess long-term upside. So even after it completely ripped on the earnings report, it went right back down. That was crazy. That's because it was capped to the upside. Unless you have a perfect setup like that, it's just not worth it to play these bloody earnings reports because you just get squeezed and then you can't do it afterwards because you're already in the position. It's better just to take the loss and wait a month to come back and not wash it. So I've been waiting after things like NVIDIA, and then you can take good shots like that, especially in this market when you get moves like that. So like I said, so much to cover. I hope it gave some good information. Bottom line, I'm very patient right now, and I'm just shorting, and I'm just waiting for it to just happen. So that's where I'm at.
Yeah, I think that was very useful, and it was a very sophisticated bear case. So I hope people will enjoy that. So yeah, I will be a little less sophisticated, just going brute force with volatility, and we're gonna see one by one what I'm seeing. Okay, let's go. Okay, you are seeing the screen now?
Yep, we can see it.
Okay, good. Okay, so we're gonna go with the big one, the elephant in the room, VIX. So I don't know if many people follow us from the past, so I will explain again the idea regarding the VIX signal. So the way it has worked so far in this bear market, yes, I still believe it's a bear market, even though NVIDIA is at 390, which is completely insane. Anytime you get the trade of volatility of VIX above the trend of volatility of VIX, so white is trend, red and green is trend, blue is trade. So blue is volatility. So anytime you get the white above the green, this is the time when you can actually buy puts, shorts, etc. Because the current environment of shorting vol as a way to make money will not work anymore, because this is the time when actually VIX bottom and start to rise, and it usually end up the same way. Actually, it's always ended up the same way. You end up with volatility of VIX crashing. This is the blue one, crashing, and basically going to what, something like 10, below 10, which corresponds to a value of VIX above 30. Okay, so trade crosses trend, you take the position in puts, you start to short the market aggressively, then trade starts to roll over, go down, and at the same time volatility of VIX crashes and you get the VIX spike. Okay, this is the principle and the idea of how you detect the end of every BMR in the market. Okay, by the way, this indicator will be available to all my fractal range subscribers that have at least 150 TKR allowance. So that's basically a premium sub plus an extra 100 TKR subscription. This one will be open to you. So I'm trying to explain how to use once you can use it. So what we had recently was we had the cross, right? We had trade crossed actually trend. It was on this day, so 17th of May, right? So this was your trigger. So of course you have to check what's the price of the market, where is it, what's the risk range, what's the upside downside ratio on MFR, just to be sure you are not actually shorting the bottom of the day, right? But that was your trigger, okay? And since then, we have entered an environment where shorting vol will get your ass fired. Okay, so now you can see the bulls on Twitter. They are like pretending everybody the dumbass, and bulls are gonna take speaks to 4,400, even 5,000. God knows where they can take it, right? So it's actually them who are about to get spanked. So now what we are seeing is that was the first trigger, trade going above trend. The second trigger was volatility actually going below trade and trend, which we got. That's why you got actually the move these past 2 days, right? From what 16 to top a little above 20. And now we are waiting for the third trigger. It doesn't happen always. It can happen that you have the directly vol crashing and VIX going. I don't think we will get that scenario. I'm thinking about another scenario. So the third trigger will be volatility actually retesting trend and possibly trade of volatility before we get the move down. Okay, so I have mentioned this value on my Twitter account. So when you project volatility onto price, you get a value. So you can see the values are there. Basically, you have 17.9, 18.07. So I would expect worst case scenario, you will get VIX to go to this kind of price, so 17.9 around there. And that should mark the bottom for VIX before the rip, okay? So of course, I'm monitoring this third trigger. I think that based on the previous scenario that I've witnessed in the past, it should happen either tomorrow or the day after. So market is closed on Monday, so I would guess Tuesday. So Tuesday top, I would expect a close below 18, which will get the bulls salivating and trolling us on Twitter for sure. And the next day, you should get the rip, at least the start of the rip for VIX. Okay, so I would remain patient. If you already shorted around that time and bought puts, I would remain patient, wait for the test of VIX around 18. Sure, we can go a little lower, right? But what you want to see is a close below 18 to trap more bulls, and then we will get the move, the move up in VIX. And when we will cover will be when this blue line, so the value of volatility of VIX, will reach its usual bottom, which is below 10, okay, which corresponds to a value of 30. Okay, so we have started to get the move. It's happening, guys. Maybe Jim Cramer can save the bulls, but it's happening. Now the question is, what will price action do while the VIX is transitioning? And we have had this discussion with Bryan. I still think they will be able to get us back to 4,200 one last time. So tomorrow, the day after tomorrow. So that's what I'm watching. I'm watching basically two triggers. One is VIX below 18 for a close, and second is the bulls to get us to 4,200. That's the two things I'm watching currently.
Yeah, Raphael, just add on one thing, kind of with like buying puts. If you're not in the puts already and you're looking at this and you want to get into the puts, the way I'm playing it, like I was adding puts every single time I saw an IV rank of 0%. So I have a good sized position. Though I think it could just puke here. I didn't add it puts today. But if we get 17.9 on VIX, what Raphael's saying, I would take stock that I'm short, I'd cover that, and I'd transition to puts to add my leverage. So that's kind of the way I'm thinking of Raphael's thing.
Okay. So then let's go see the indexes I'm watching. So I use the cash ones. Their signal usually works better. So I have mentioned this also the last time. So I have how to say a minimum value for the daily volatility of an asset where actually I will add to shorts. So this minimum value, so this is again the blue line for US 500 is 0.8. So I say this because again you will have access to this indicator starting this weekend. So that's why I would suggest you mark this value when I say them. So 0.8 for the blue is the minimum value on the daily where you can actually safely short or buy puts, etc. for US 500. So basically the SPIX or SPY. I just use US 500 as a derivative for this. So you had such values on the 19th of April, you had such value on the 1st of May, and you had such value on the 19th of May, and again on the 29th of May and 22nd of May. So if you shorted at that time, if you bought puts at that time, for now you are not suffering. You are watching this shit show going on relatively safely. So now the question is, when do we get this vol spike? So basically blue to climb above the white line and then start to skyrocket and get this sell-off that we are all waiting for. I don't know, but I told you what I'm looking for the VIX. So when you see the VIX do what I told you, I would expect the volatility of US 500 to climb. Nasdaq looks the same. It's just that it's been more tricky to short on every minimum daily vol because they keep ramping up. The thing is, so that's another thing I look at. So again, to teach you how to use this volatility indicator, what I watch is the minimum value, potential value on the daily for trade. So I go in the past, I look at the minimum value that this white line went to on daily for a particular asset I'm looking at. Could be from last year, 2 years, 3 years ago. And I mark it on this indicator because this is the minimum value it will go to before the blue line blows up. So volatility blows up and then the price goes down, right? So on Nasdaq, I think the value is lower. So I don't think we're going to get there. But I'm going to show you some tech stocks that's actually already there. So I would expect this blue line to go up, so volatility to spike. The question is when. I would guess when we get the VIX move, because SPIX and Nasdaq should crash at the same time, and I'm actually thinking it will be the tech that will trigger this sell-off. So now we're going to go to some juicy tech stocks. Sorry, I need to find them. Okay, so the one I really like, I have mentioned it several times in my feed, it's Apple. So why Apple? I think it's very juicy. It's because the previous daily mean, Volatrade daily mean from, I think it was 3 years ago, it was in 2020 then, was the value was 2.6, okay? So currently the value of trade is 2.3. So trade is below. So trade is compressing volatility. And at some point, volatility will have no more room to go down. So volatility will need to breathe. And the way it's going to do is it's going to actually pop above the volatility of trade. And this is when you get the sell-off. So you can see that for now, since a few days, maybe I would say a week, I cannot see the day, but since that particular day, the volatility trade is below the mean of 2.6. Okay, so starting today, you can start the clock on Apple. At some point, this blue line is going to explode. Will it just retest the trend, so the green line, or will it explode to get us to some volatility level values, sorry, that we got in the previous sell-off? So you can see here, you can see here, 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 and that would take the price much lower, probably in the 140 area. For now, I'm not being greedy. I'm just waiting for the volatility to blow and to get back to trend, so around 8.3. So this is very nice setup. I bought some puts on Apple. I actually also I'm actually shorting also the stock. So this one I have very high confidence we're gonna get it. Another one I bought puts on MSFT, but this one maybe I was a little bit greedy. It's showing the same thing. You get trade being smacked down, and volatility is just getting compressed and compressed to the ground, and at some point this thing is gonna explode. So I have no idea what will be the trigger, but it's getting narrow. The window of weakness, like Chem coined, is getting very close, especially with all the things I have told you before about the VIX. So yeah, that's for VIX, that's for indexes, that's for some stocks. And now I want to go to yields. So let's go to the 2-year first. So if you remember several months ago, so basically when we broke, I think I still, sorry, I will move this so I can see the dates. Yes, 13th of March. Oof, it's a long time ago. So 13th of March, we saw the break of trend on the 2-year. It happened there. And I told at some point we're gonna reclaim. Okay, the Fed has to keep raising rates. They said they would do it, and this time they will do it. Okay, people are still trying to call their bluff. That's why you get actually the squeeze in tech. I think they are really suicidal. And consider all the clues I have given you so far today regarding VIX, regarding the indexes, regarding the tech stocks. I mean, they are really, really, they are insane. I don't know why they do this, but they are insane. And now you can see that it broke trade here, and now we already reclaimed the trend. Okay, so where are we going to on the 2-year? So from what I see, my base case is volatility should reach the mean point that it had reached before. So the value is around something like 1, let's say, and we are still at 10. So you can see there is a huge runway for volatility of US 2-year to keep going lower. So an estimate for the target of the 2-year to maybe 5.3 is not crazy. I think it's totally feasible. No idea about the time frame, but based on volatility, it means totally feasible. So can you imagine all these guys who said, oh, the Fed is bluffing, it's so impossible. The economy cannot sustain 4%, and US 2-year, I think is going to break the previous high, and we're going to go to 5.3 something. The 10-year is actually exhibiting the same behavior, although the volatility has less room to run. So yeah, you can see the volatility of the 10-year has less room, right? The minimum is 2.2, is around 2. We are already at 4.4, so I'm less greedy. I would say the 10-year should reach a target or maybe 4. No idea if we can break the high on this one, but we should reach a level somewhere here. Okay, and one should not expect a breakdown of the asset until you at least get the trade to go down and start compressing the volatility. And the trade is just starting to move, right? We are barely crossing trend, so I would not expect anything before. Sorry, I cannot see the date. yeah, first week of June. Okay, if you really want to short the short bonds in relation to this one, the 10-year, yeah, I would wait at least the end of the first week of June to take again a look at the volatility structure. So that's very interesting, right? We are seeing a lot of runway possible for the 2-year and some runway for the 10-year, meaning bonds should keep falling. But at the same time, they are still chasing tech with a very nice setup for blow up. The last thing, I think is the last thing I wanted to show is the gold. Okay. Okay, I need to move this because I again cannot see. Okay, so gold, so so it happens, the same thing happened on gold. So you had the trade going down, and at some point it was compressing vol so much that vol had to explode. So volatility is the blue, so volatility of gold exploded. That's why you get the sell-off, right? That's very simple to understand. And now where vol is going, so it tried to hold trend. You can see these are the retest of price on trend, and it didn't. Okay, today we got the breakdown. Now, where volatility is going, the safest bet is at least to the top where it went the last time. So the top is at, from the last time it was 7.4. Currently, vol is at 5.4. Okay, so you should expect at least the blue line to reach this place before at least maybe getting some kind of bottom, short-term bottom in gold before the next move up if you're bull, or at least a place to cover your short if you are bear. So I think the target should be around maybe 1,900. That would be a good idea for a destination, but I don't know in advance, right? I need to wait for blue to reach this maximum, and then we can see, okay, where is the gold price at that time? Okay, that's a good place to cover some, or maybe cover all if you are short. Will it be interesting to actually keep holding this short if we are reaching there and you want to keep it? If you see the volatility of gold in the past, it has reached some level above 12, 11, 12. So there would be still some runway, but you would need confirmation from other tools such as MFR, MyFractal range, to see does gold still have remaining downside. So upside downside ratio will help you to do that. Long-term downside also will help you to do that. But yeah, first target should be the one I marked. Yeah, something else. While Bryan was talking, I got a mega buy signal on the Euro USD. So I already got a buy signal, but it disappeared. I closed 2/3 of my positions, my position last week on Euro USD and UUP, and now we have mega buy. So I will see tomorrow if it's still there or not, and I will reduce again my short position in Euro USD and my long position in UUP. Doesn't mean I'm not a bull in UUP. I'm just sticking to my process because I don't want to get run over. Okay, that's it. I will stop sharing. And yeah, maybe we go to questions in YouTube. Okay, so Evaldas, we got UK core inflation started rising again. What are your thoughts about that? And do you see the same coming to the US? So, Christopher, you want to do macro or?
Yeah, I was currently looking at some inflation data for the UK. So basically, analyzing UK, you can start at, it's a net importer of goods. So they got a pretty big divergence in the share of industrial production, which is versus service production. So they basically starting importing inflation from other countries, even if some of their consumer prices or input prices, if I currently look at the monthly levels of falling on a year-over-year basis, they're still at pretty high numbers. So food products, beverages, tobacco, still at 11.1%. Chemicals also falling rather quickly, but in general, they are really ticking at a higher level, even if they're falling. So that's the thing, keeping a country going without heavy industrial production. If it's not in its mainland, it's pretty hard.
So the countries which are deindustrialized are the ones that really suffer the most from inflation, right?
Yeah, okay. They do. They really do. Otherwise, I haven't really looked at UK. I would need to do that because something is going on there, which is pretty interesting. If you look at the interest rates, they're really crashing down. So, and I kind of also liked the trueflation measures recently I saw on Twitter. So which is a service provider survey. I don't know how they measure this data, but I haven't looked into it. But they showed that UK was at 16% inflation rate year-over-year still. So I don't know. At the current state, I think it's they're importing their inflation for industrial production.
And
so
do you see the same? Sorry.
Yeah, you cannot keep a company going with a high service sector, especially if there are lots of financial parts in their system. So that's a pretty big problem for the UK.
And do you think the same thing is possible in the US, reaccelerating inflation?
Actually, I would say that it really depends on interest, the spending on for the net interest spending from the government bonds. So they're running a pretty high deficit. So and you got a pretty good correlation for deficit spending and inflation. But I currently do not see any long-term uptick in core inflation at this current time in the US. So I think they got a different foundation in their entity structure. So I think inflation will most likely be slowing down. If they cut rates, the inflation numbers will even tick down a bit quicker, in my opinion. So I don't see any worries at this current time.
Okay. Okay, so this one is for you, Bryan. I would guess, is TLT GLD bottoming in long-term range? Will this mean next leg down in stocks might be deflation, not inflation? If yes, does this mean SPY TLT correlation will be negative and we may not get a deep down leg?
I have absolutely no idea.
Yeah.
I mean, I know that like the skew's not great. It's not bottoming though, so we don't have like cap. It was really interesting before the deflationary risk off that we had in March with the bank blowups. We saw gold get capped to the downside, and we saw dollar get capped to the upside. It was very clear. I didn't know what it meant at the time, and I didn't execute it quite on how I would like to execute on it. But we're not getting that this time on bonds. I find it really interesting that you got a mega buy signal on Euro USD. So that kind of makes me think maybe. I mean, like, so if they default in the debt, does the dollar blow up? Is that what's supposed to happen? Or does the dollar rip? I don't really know. If the dollar blows up, then and bonds rip. People try to cite what happened in 2011, but it's a totally different environment. Like we were like starting QE then, and we weren't having any inflation, and bonds didn't have the sell before. Like bonds are already bidding at that time, and gold ripped and bonds ripped and VIX ripped on the 2011 debt ceiling thing. So I don't think it's going to be the exact same thing this time, but I don't know. It could be deflationary risk off, but right now, everything besides tech is inflationary risk off, is what we're seeing right now in terms of bonds getting wrecked, dollar bidding, gold bidding, or selling, and Russell and everything else besides tech selling. So we're just gonna have to see, man. I don't know. I'm not buying bonds if that's what you're asking.
Yeah.
The Fed's still hiking. They're gonna hike more. I was just flipping through the CME Fed Watch tool. Like nothing between now and December is pricing anything besides a terminal rate of 5.75, which would be 2 more 25 basis points hikes. So that's the most they're pricing right now is 2 more hikes. And every single time we get a hike, this is the last one. This is the last one. This is the last one. And they're still hiking. So there's no, I don't know why you would buy bonds. Every single time you bought bonds, it hasn't worked. And
yeah, if you really want to buy bonds when volatility of the bond is at is near the volatility of the yield in relation to the bond is at the mean. At least you are not taking risk, and right now we are not there yet. So
yeah, quite frankly, my gut reaction is that this all like I don't see some big turn coming in bonds and a big turn in dollar and a big turn in gold. It just doesn't quite make sense the way that it's really consistently sold right now against equities that have held up. So my gut reaction is that it's all about to puke together. That's my gut reaction. I could be wrong. I was wrong in March when I felt that same kind of thing, but we'll see.
yeah, correlations are crap, so that's the issue right now.
Correlations are a disaster. If you look at like IWM, for example, IWM TLT or IWM bond correlation is positive.
Yeah,
it's positive. So it's like they're not a signal for me until they start acting right. They're not acting right now. They're not telling you anything. They're not calling bottoms. They're not calling tops. So I just put a little weight in them right now.
Yeah. So regarding yield, so yeah, I'm getting some sell signals for the past few days, but again, vol is not there yet. It could go lower, and the DXY is not far from mean value of volatility itself. And now you get the mega buy signal in your USD, and I'm checking the mega buy. It's actually pretty accurate. So I don't know, maybe another few days like this, maybe the signal just disappear.
Well, it looks like it's been accurate, Raph, but it doesn't it hasn't led to anything more than just a temporary bounce.
Yeah, if you have, exactly. If really Euro USD is about to transition into bearish, it's just like a pause, right? It's pausing, then you get either a small bounce or just flat action for a few weeks, and then starts the next leg down. So yeah, sure. But
yeah. So I think it means like don't capitulate on your dollar long, but don't maybe add more dollar right now. Me personally, I'm just a perma dollar long that I've just been holding for the last year because I want long-term capital gains on it. That's the way I play the dollar, but I know people capitulate at the lows, and I wouldn't chase it here.
Yeah, I'm actually thinking of getting rid of the foreign exchange positions. I mean, it's another thing I need to put my brain on, and I'm very lazy in terms of. I mean, I like the tech short, right? I think this thing is going to blow up like very bad. I don't want to have to focus on the dollar and Euro USD while it's happening. So I don't know. Maybe I will check.
It makes sense though. Like one thing that so I've been like through this like squeeze and whatnot and rips. Like I've been aggressively long dollar and aggressively short gold. Like I have a 30% position long dollar and a 30% position short gold. Like it's basically long that spread. And man, it saved me a lot when I thought that stocks were about to puke and stocks rip and squeeze me, but you get dollar up and gold down on that. It's been a really good hedge. People are saying like long bond is the hedge right now or long gold is the hedge. It's not. Like if you're hedging your short stock position, short bonds and short gold is actually the hedge, because if stocks keep ripping, the Fed's going to keep hiking. I don't think you can get like deflationary risk on like we had in October to January. I don't think you can get that like that Goldilocks deflationary risk on, because we're not coming down aggressively from a high point on inflation. we're not overpricing Fed hawkishness. We could be right on Fed hawkishness. We could be, I think, underpricing, but we're definitely not overpricing Fed hawkishness. So I don't think you have to be worried about stocks up, bonds up. I personally, I could be wrong. If we get stocks up, bonds up, my portfolio is going to get whacked. That's the biggest risk for me. I just think that it's unlikely from a macro perspective. And so under that, guys, like long bonds is most certainly not the hedge. Long gold is most certainly not the hedge. If you're long bonds and long gold, you better be right on your equity shorts, because then if your equity shorts go down, that'll cover you on your bonds and your gold going down. If you're right on deflationary risk off, then yeah, your long bonds will be up, gold will be up, stocks will be down. And so you'll make a pile on that, like some people might have done in March, but it's not a hedge in that manner. The hedge, you actually want to hedge more Fed hawkishness and inflationary risk off right now, which would be shorting bonds and shorting gold and long dollar.
Yeah. Especially, I think the next puke we get is not the deflation puke. It's some kind of reaction to, okay, oh my God, inflation is sticky and it's still there, and the Fed is gonna just keep raising. So the next puke should be inflationary puke. So basically, yields keep rising, and at some point it's gonna be too high, and stocks are gonna puke, and inflation will be really tame there, and then we can buy bonds. Then we can buy bonds. And we shall see what happens then. But,
yeah, because like I mean, so I that was in my opinion, that was about to happen in March. It was happening. They were up shifting to 50 basis points. Bonds were getting hit. Gold were getting hit. Stocks was falling. It was happening, and then the bloody SVB blew up, and it ruined everything, and it flipped the correlation. So now I think we have another shot at that happening, whether there's another catastrophic event. Some people, their reasoning for being long bonds here is, what was the reason given into me? Because more stuff's going to blow up. Well, what if the bonds are what blows up? Then, because that's a perfectly fine risk. And like, as far as inflation, if you look at the year-over-year statistics, like clearly it looks like it's falling, but like that doesn't tell you anything. If you look at it on like a month-over-month or a 3-month annualized basis, and you look at core inflation, it's gone nowhere for 6 months. It's completely flat. So inflation's not falling. It might be on a year-over-year statistics, but then what happens when we get to the end of this year and we lap those base effects and we get back on a year-over-year track, and then year-over-year inflation starts rising again because core inflation has gone nowhere. So as far as right now, inflation is not really falling if you look at it like specifically. In my opinion, Chris could tell me I'm wrong, but it's just my basic look at it.
Yeah, I'm kind of with you. So on the base effects there, you can see inflation falling, definitely. But I always like to look at Fed funds. So there's some pretty good arguments that raising Fed funds raises inflation, which is counterintuitive to some degree, which most likely what most economists say, and also basically to the net interest payment of the Fed, raising interest rates, subsequently Fed funds raises the interest rates, also raises net interest payments to the bondholders, which is their interest income. So they got more spending, which is most likely wealthy, the wealthy population of the US, and also it also raises deficits for the US. So we never had a crash in the US with deficits that high. So, and you can look at Japan. They did not raise rates that high, and their inflation numbers are tamed. If you want to have a different point of view. So they did raise a bit, but not as high as the US did. And yeah, I mean, like the interest rates, even if they do a yield curve control, they look pretty normal. Their overall economy has not this inflationary, or did not had the inflationary shock as US or Europe did. So basically, this is the argument for me. If they really did a hard stop for raising Fed funds, this could basically lead to a more complex outcome for the economy. So this is what I try to always assess, is like loan growth versus deficit spending. So if it's, and you can also get some pretty decent correlations out of it. So if most loan growths are falling and you get like support from government spending, this can always help stabilize an economy. And this is what in some kind the economist Minsky always said, as the complex structures develop if loan growth raises to a certain level. The possibilities of nonlinear moves in a complex systems are, or they then have a higher probability of happening. And this is what happened basically in the GFC. So yeah, that's my point for it.
There was another question, but it's what will be the impact of debt ceiling decision on bonds? No idea. All I know is the yields are printing sell, but voila is not at mean. So that's what I see. And anybody knows when it's going to happen? Because the question is, every time we have a setup, magically some kind of event happens, right? So you were mentioning before the bank blow up. So we were about to tank, right? The market was about to take, we were about to get what we were expecting. Bonds crashing, gold crashing, stocks crashing. That's what we were setting up for. And then, oh, magically, a bank is blowing up. And what's her name? The woman who looks like a witch.
Janet Yellen?
Yeah. Then, oh, I'm gonna help you. I'm gonna help you. And she put some money inside, and everybody's like, oh my God, this is it. Deflation, bonds, let's buy bonds, let's buy gold, let's buy stock, let's buy tech. So dumb.
I'm no pro on the liquidity. I just listen to some people that talk about it. It's like, so what I've heard is like the way that the debt ceiling thing is, and I don't, this is not my specialty, but the way I understand it is it's a lose-lose situation. If there's a deal, they have to refill the TGA and that drains liquidity. If there's no deal, it's the apocalypse. So it's like, I think it just loses either way. I guess it depends what outcome it is. So I guess a bad one would be bonds. If there's no deal, bonds collapse. But then if there is a deal and they have to redrain the TGA, then you're looking at more bond volatility and bonds sell more. Or maybe that's what bonds are front running now. Their bonds are just probably front running now, the lose-lose situation that there's no bid for them. Like you've literally watched them go no bid, but people are still buying the dips and getting more long bonds. Like, what are you doing, man? There's like, this is like, it's literally doing the same. Okay, I was a bond bull last year. Let's be very clear here. I was an absolute fool and I got my mind twisted. Finally, I got it right. I was a bond bull last year. Complete disaster. It is doing the same action that it was from August to October, and from January to the entire first half of the year, all the way through October, is doing the same action. What we started to see and doing the same action that we started to see in February and March as well. It's just going no bid. There's literally no bid. The bounces on this thing are so weak, and it's going to new lows. So yeah, stop trying to buy bonds.
Yeah, what I was meaning regarding the random conjunction of event, exactly when you get the signal is, so we have the sell signal on bonds, sell signal on yields, and I would say maybe the trigger would be end of first, beginning of second week of June. So my best guess would be, okay, they will magically find a solution right at that time. Okay, so that would be my bet. Nothing happens, they have no deal, and first week of June, end of first week, beginning of second week of June. Oh my God, we have magically find a common ground, and then bonds actually work for a few weeks, and then the Fed has to do something else in July to stop this thing from inflation from coming back. So we know, I would guess, yeah, in June, mid-June we can see, but that's where my money is right now.
Yeah,
Okay.
we won't know till it happens. There is some pretty creepy stuff going on here. You got like the SVB stuff, and then you got Druck like ticking the bottom on the dollar and saying he's long Nvidia right before the blow up or the rip higher.
Yeah, I mean, they really think people are fools. I mean, come on. I mean, no, the market is not manipulated. You guys are doing some conspiracy theory for sure.
And for me and my return analysis, so I got for TLT midpoint is at optimized at around about 160 days. So today it actually broke trend again. So it's a bearish momentum for me. And the entropy measure, which signals unpredictability, it raises. So in the it's pretty high in the 50-day. It's also pretty high in the 100-day and also in the 200-day. And my HERS estimation, it's trapped at anti-persistence. So this thing is really not taking to bid up to a bullish momentum for now. I recently got like a little breakout signal, but this thing turned again. So yeah, and it's also the distribution is also stable. So there's no non-linear moves currently. Yeah. So and for GLD, I also got a again, it's still bullish trend for me, but I also got some sell signals there. Yeah, which I mentioned on Twitter recently. So it's actually confirmed with you too.
And yeah, I mean, gold relatively worked. So we are just talking about when to short and when to long at very specific points, right? I mean, gold has been a nice asset allocation since last year. So we are just talking about particular points to maintain the position. Okay, guys, I can't believe this, but almost 2 hours. So, okay, let's go to the bet we did. So the first bet was new closing high for SPY. So no was Vi and Bry, and yes was Ted, Robbie, and I. So we got the new closing high, the next closing high.
Congrats,
So,
man.
yeah, the strike of bad luck and bad bets ended. Unfortunately, I wanted the other outcome, but yeah. And the other one was TLT below 101. I think we got there, right?
Oh yeah.
That was so yes was you and Robbie. So actually Robbie got the two correctly, and
job,
you got
Robbie.
the TLT despite every long TLT guys absolutely losing their nerve every time you mention short TLT, right? I mean, it's insane. I mean, how many times you gonna buy TLT? Like it should be the 5th or 6th times, and I mean, maybe you should learn. I don't know.
Maybe this time they just won't capitulate and
Yeah.
it just crashes. Like Ashley does.
Inflation. They should check the back test of bonds, yields during the last inflationary issues that the world faced, and maybe they will revise their way of thinking regarding bonds. I don't know. So yeah, I think it's good, guys. We lost Ted because he had to go. Next one is in 2 weeks.
Wait, what's the bet? One bet.
Okay, let's do a bet. Yeah,
Fix.
yeah.
We're just gonna agree. Let's do Apple.
Okay. In 2 weeks, right?
Apple in 2 weeks. Do we see a new high? New closing high.
Well, it's hard to say. I prefer a target like I will reach like a low point.
All right.
I'm going with the 165. I think we're gonna have reached at least 165.
Okay, you're 165. I'm 159.7.
Yeah. Give me like 2 minutes and I run my model real quick. So
Okay, you're cheating. Brian, you say what?
159.7.
Frankly, if the market has not tanked in 2 weeks, I don't get it. I mean, it would be the first time they save it on VIX. I mean, it's entirely possible. I mean, maybe we are in a bull market and we just delusional. I don't know.
I don't think so, man.
That would be the first time so 5 times it worked, right? Since November when we entered the bear market. So this is the 6th time, I think. If it doesn't work, we are definitely in a bull market.
Yeah, it's either a bear market or it's December 2nd, 2020. Right? Because that's when we crossed trend and then didn't look back.
Talking about VIX?
Yeah, VIX. December 2nd, 2020.
December 2nd, 2021, you mean?
2020.
Ah, you mean every time it worked?
Well, so if you look, so December, so after the COVID puke, December 2nd, 2020, that's when VIX crossed.
Yeah.
It didn't look back.
Yeah, until August 21. Yeah, so it nailed it. Yeah, the system works. I tell you, the volatility always works. So basically, yeah, we crossed, like you said, December 20, August 21. That was the craziest bull market we've seen, right? It was insane.
Yeah.
So yeah, since then we are in the sequence I mentioned with the VIX. Anytime we have trade crossing trend, we get the VIX spike because they are stopping it. They are saying no, we are not going back to bull market. So yeah.
Yep.
Okay, sorry, Chris.
So I'm
Still running.
Let's go. What'd you say? What was your bet?
So lowest value for Apple in 2 weeks.
Lowest value, so I would say it's like 170. 170.
Okay, you are doing very cautious. Okay, not betting on the crash. Okay, guys, that's good. Let's wrap this up. And yeah, in 2 weeks, Vi will be back, and maybe Robbie. And yeah, I hope you find it useful. And you can see we are pretty bared up. Now the question is, are these things set up? I don't know, but I really hope the tech bulls get wrecked in the next 2 weeks. They are insufferable. Because my feed, I try to not follow bears because it destroy my brain. So I just don't follow the bears. I follow the bulls, and I've never seen that. I mean, they are worse than the bears. They are really worse. So I wish them to, like, they don't understand why VIX is going up. Like, what's happening? Why tech is selling? So yeah. Anyway. Okay, guys.
See.
Okay. So
yeah, we'll see.
Have a good